Imagine waking up in charge of America's bills. On your desk sits a red folder. Inside is one number, $40 trillion. Yet hospitals open, soldiers are paid, Wall Street keeps lending. No alarm sounds because America does not have to repay everything today. It only has to keep borrowing. And that is the twist. The danger is not America running out of dollars. It is normal interest rates becoming politically unaffordable. Because then the debt stops being a number. It starts making the decisions. $40 trillion is a number large enough to become almost meaningless. Divide it by the population and you get roughly $120,000 for every American. Dramatic. Also slightly deceptive. No newborn receives a Treasury invoice with the birth certificate. The headline measures gross federal debt. A little over $32 trillion is debt held by the public. That includes American investors, pension funds, banks, foreign institutions, and the Federal Reserve. Most of the remainder is held inside the government itself, largely through accounts such as the Social Security trust funds. Those obligations still matter, but they are not identical to money borrowed directly from financial markets. And unlike a household loan, the national debt does not have one final repayment date. Individual Treasury securities mature constantly. Washington normally pays them by selling new ones. So the real danger is not that $40 trillion suddenly becomes due next Tuesday. It is the trajectory. How much new debt is being added, how quickly old debt must be refinanced, and how much investors demand in return. At the turn of the century, the United States federal budget briefly ran surpluses. Washington was collecting more than it spent. Then history arrived, carrying some very expensive hobbies. Tax cuts reduced revenue, wars increased spending. The financial crisis of 2008 demanded a rescue. An aging population pushed Social Security and Medicare costs higher. Then the pandemic required trillions of dollars in emergency support. Meanwhile, interest rates remained close to zero for years. Borrowing felt almost painless, so choices that should have required difficult arguments could simply be postponed. None of this belongs to one president or one political party. Republicans cut taxes without matching spending cuts. Democrats expanded programs without matching revenues. Both used emergencies, some unavoidable and others remarkably convenient, to leave the next administration with a larger tab. The problem is that emergency borrowing never fully went home. For fiscal year 2026, the Congressional Budget Office projects that the federal government will spend around $7.4 trillion while collecting about $5.6 trillion. The gap is roughly $1.9 trillion, and this is not during another Great Depression. It is now close to routine. Borrowing became a form of political anesthesia. The benefits arrive today. The real cost is delayed, divided, and buried inside Treasury auctions that few voters will ever see. Taxes create angry headlines immediately. Spending cuts create angry voters immediately. Debt creates a press conference about responsibility, followed by another auction. That is how America reached $40 trillion. Not through one catastrophic decision, through thousands of decisions that were each easier to finance than to confront. Running a deficit only works if somebody agrees to finance it. Whenever Washington needs money, the Treasury sells bills, notes, and bonds. Investors hand over dollars. In exchange, the government promises interest and repayment at a later date. So, who keeps lending? Mostly Americans. Domestic investors hold roughly 70% of the federal debt owned by the public. That includes mutual funds, pension funds, banks, insurance companies, households, and the Federal Reserve. Foreign investors hold the remaining share. Japan is one of the largest foreign holders. China owns far less than many dramatic internet headlines suggest. It cannot simply call Washington and demand its money back before lunch. But why does anyone keep buying? Because Treasury securities do much more than finance the government. A pension fund uses them to preserve savings. A bank uses them as collateral. A central bank uses them to store dollar reserves. Financial markets use their yields to price everything from corporate bonds to mortgages. Treasuries are essentially the standard shipping container of global finance, not glamorous, but accepted almost everywhere and capable of carrying enormous amounts of money. This gives America an extraordinary privilege. It borrows in its own currency from a world that actively needs dollar assets. But here is the catch. Washington can usually find a buyer. What it cannot guarantee is the price that buyer will demand. For years, America's growing debt looked manageable because money was cheap. After the financial crisis of 2008, interest rates remained close to zero for much of the following decade. Washington could borrow enormous amounts without immediately feeling the full weight. But cheap debt does not remain cheap forever. Treasury securities constantly mature. When an older bond reaches its repayment date, Washington usually replaces it by issuing a new one. If the old bond carried a rate of 2%, but the replacement requires 4 or 5%, the government has not borrowed more money for a new bridge, hospital, or aircraft. It is simply paying more to maintain debt that already exists. And the change does not happen all at once. Higher rates gradually spread through the debt as old securities mature and are refinanced. Quietly, month after month. This creates what we can call the fiscal ratchet. The government runs a deficit, so it borrows. More debt creates more interest. More interest enlarges the next deficit. That larger deficit requires even more borrowing. Click, then another click. For fiscal year 2026, net federal interest spending is expected to exceed $1 trillion. By 2036, the Congressional Budget Office projects that it could reach roughly $2.1 trillion per year. Interest is becoming one of Washington's largest expenses, and it produces nothing new. No teacher is hired, no road is repaired, no soldier is equipped. It is the cost of decisions already made. This is why the $40 trillion threshold matters. Not because the entire balance suddenly becomes payable, but because every percentage point now carries enormous weight. At low rates, debt was easier to ignore. At higher rates, it starts competing with the government itself. And once interest costs are financed with still more borrowing, the debt is no longer merely growing. It is beginning to feed on its own budget. Imagine a nurse and an electrician who have spent 7 years saving for their first home. They finally find one they can afford. Then the bank calculates the mortgage. The monthly payment is hundreds of dollars higher than they expected because the interest rate has climbed. They never voted to issue a Treasury bond. They never borrowed money for Washington, yet the federal debt has still entered the room. Treasury yields help establish the basic price of borrowing across the economy. When investors demand more interest from the government, mortgage rates, corporate bonds, and business loans can also become more expensive. Federal debt is not the only force pushing those rates higher. Inflation and Federal Reserve policy matter too. But when Washington competes for enormous amounts of capital year after year, everybody else is borrowing in the same crowded room. The second cost appears inside the federal budget. Every dollar paid in interest is a dollar that cannot easily fund infrastructure, healthcare, defense, education, or the next emergency. This does not mean those programs disappear tomorrow. It means every future decision becomes tighter. The consequences arrive gradually. Weaker investment, higher borrowing costs, less room to respond when something breaks. America does not need a spectacular default to suffer from excessive debt. It can simply become poorer than it needed to be. And if watching public finance slowly transform into a horror film made in Excel is somehow your idea of entertainment, subscribe. At least then, none of us will suffer alone. At this point, the obvious question appears: If America owes the debt in dollars, why not simply create more dollars? Technically, the Treasury cannot do that. The Treasury collects taxes, spends money, and issues debt. The Federal Reserve controls the monetary machinery. The Fed can create bank reserves and use them to purchase Treasury securities. That can increase demand for government debt, push bond prices higher, and help bring yields lower. This is broadly what happens during quantitative easing. But it is not free money. Moving Treasury debt onto the Federal Reserve's balance sheet changes who holds the debt. It does not create new workers, new factories, new energy, or new goods. Money can be created digitally in seconds. The real economy remains stubbornly analog, and creating money does not automatically create consumer inflation. The outcome depends on the state of the economy, lending, demand, and where the liquidity flows. But if monetary creation is used persistently to help finance government spending while the economy is already operating near its limits, the risk changes. More money begins competing for the same real resources. Prices can rise, savings lose purchasing power. Investors may demand even higher yields to compensate. America has faced this conflict before. During the Second World War, the Federal Reserve held Treasury, borrowing costs artificially low to help Washington finance the war. Maintaining those rates required the Fed to keep purchasing government securities. After the war, inflation rose. The Treasury wanted cheap financing. The Fed wanted the freedom to control prices. The confrontation eventually produced the Treasury and Federal Reserve Accord of 1951, which helped restore the central bank's independence. The modern version of this danger is called fiscal dominance. It begins when the government's financing needs become so powerful that the central bank can no longer focus freely on inflation and employment. The Federal Reserve is not there today, but $40 trillion changes the incentives. The larger the debt becomes, the more politically attractive lower rates, renewed bond purchases, and moderate inflation may appear. So, the printer is coming is not a description of what America is doing now. It is a warning about the choice that may eventually become easier than all the others. If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. So, if printing money is not free, what can Washington actually do? There are 5 doors. Behind the first is economic growth. If the economy grows faster than the debt, tax revenues rise and the burden becomes smaller relative to national income. This is the least painful solution. Unfortunately, productivity cannot be summoned through a press conference. Behind the second door are higher taxes. America collects less revenue relative to the size of its economy than many other wealthy countries. That means additional revenue is possible. It also means politicians would have to tell voters exactly who is paying. Behind the third door are spending cuts, but balancing the budget would require more than deleting suspicious office furniture and holding another press conference about government waste. The largest pressures come from major programs, including Social Security, Medicare, defense, and interest itself. Meaningful cuts would touch benefits and services that millions of people actually use. The fourth door is financial repression. Keep interest rates below economic growth, tolerate some inflation, and allow the real value of the debt to erode gradually. No official default, no dramatic announcement. Just savers and wage earners discovering that their dollars buy less. The fifth door is an actual default or restructuring. For a government borrowing in its own currency, this would most likely be a political decision rather than a simple inability to find dollars. It would also damage the asset supporting much of global finance. So, not exactly a relaxing weekend project. There is no sixth door marked free. The realistic solution is probably an uncomfortable combination of growth, higher revenue, spending restraint, and gradual inflation. The political question is not whether someone will pay. It is whether the payment will be visible. From here, the story can move in three directions. The first is managed erosion. Economic growth remains strong. Congress adopts gradual reforms. Deficits narrow, while moderate inflation reduces part of the debt's real weight. The total number may continue rising, but the burden stabilizes relative to the economy. Not heroic, but functional. The second future is the slow squeeze. Nothing suddenly collapses. Investors continue buying treasuries. The dollar remains dominant. But interest absorbs more of the budget. Private borrowing stays expensive. Washington has less room to respond to recessions, wars, or financial shocks. America remains rich. It simply becomes less flexible, less productive, and more constrained every year. This is probably the most realistic danger, because decline rarely has the courtesy to announce itself. The third future is a confidence shock. Perhaps inflation returns. Perhaps political leaders deliberately flirt with default. Perhaps investors simply demand much higher compensation to hold long-term debt. Bond yields jump. Interest costs rise faster, and the Federal Reserve faces an ugly decision. Allow rates to remain high and intensify the fiscal pressure, or intervene, support the bond market, and risk weakening confidence in the dollar. The United States would still not run out of dollars, but it could begin running out of cheap trust. And when the world's safest borrower must pay increasingly unsafe prices, $40 trillion stops being a milestone. It becomes a constraint. Final thoughts. The creditor in the room. $40 trillion is not a countdown. It is a corridor narrowing with every step. America can still pay. It can still borrow. But more of its future is already committed before the next crisis even begins. The bill will not arrive with your name on it. It will appear through higher mortgages, weaker investment, higher taxes, fewer public choices, or a dollar that buys less. Wealth buys time. The dollar buys privilege. Neither cancels arithmetic. And if the printer returns, it will not erase the cost. It will only decide who pays it. So, when debt begins choosing what a country can afford, who is really in charge? The voters, the markets, or the debt itself?